And good thing Kelsey's there to give us a helpful reminder. So we have, we're rolling into chapter 5 today. I know there's a couple slides from chapter 4 that we didn't finish yet. I will have time one of the afternoons when we get into chapter 15, and we'll roll it in there. It's perfectly fine. This allows us to keep the flow a little bit closer to how it's originally laid out. So we're going to go into the RRSP and RIF today, or this morning anyways, and then DPSP sort of time permitting. Yeah, Kelsey was good enough to pop on and remind us. So FP Canada released their exam plan on, I want to say Tuesday, I think it was, of last week. And the plan here is going to be that there's going to be a dual set of exams. There will be online, self, whatever, at home or at work. And there's also going to be live. So you're going to write your exam potentially in one of those two scenarios. They have the complete list of exam centers. And basically it's all major centers, okay? Now, no Peace Country. So for those in Peace Country, there's nothing up there. So Robert and, sorry, I can't remember who else is in Peace Country. I know some of you have been, but I think Robert's, no, wait, sorry. I don't remember who else is up there. But anyways, if you're in a place like that, you're either traveling to write or you're gonna write at your home or office. And if you're gonna write, I don't know if anybody has experience with this kind of thing, but in a proctored setting, so the exam date for the level, or sorry, for QAFP, thanks Kelsey, the QFP exam date is going to be Monday, the 23rd of November. And no, Sean, they won't come out with the right date for 2021 until early 2021, until February, March of 2021. Now, what we, yeah, thanks Sherry, appreciate it. What you can roughly count on here, very roughly, is that it will be the last week of May or first week of June. Okay, it's going to be in that ballpark. I don't know closer than that how it's going to play out, and especially this write will be quite instructive for how they schedule that next set of writes, assuming that we're still in some sort of pandemic mode then. Okay. I hope honestly that this does create a change. I've always found it a little bit inherently unfair that somebody from whatever remote neck of the woods has to travel, whereas, you know, if you're in Kitchener-Waterloo, you have at most a 25-minute commute to go write the exam. Okay, fair? Maybe a half hour, but you get the point, right? So what'll happen for the online at home at work, there is an FAQ dealing with this on FP Canada website. Okay, and basically it's going to be, you have to be in a clean environment. So the way it works, you're right on your computer with your camera live. Okay, sorry, somebody from Cooperators just logged in, and A23167P. I don't know if you want to rename yourself or let me know who that is, but I know it's a Cooperators person, and I'm just not sure who it is. All right, nice, Stephen. So the yeah, so the way this works is when you start, you're gonna flash your camera around. Basically, you pick up your laptop and you'll rotate it around 360 degrees and show that you're in a room that's got no nothing in it. So yeah, that's exactly right. Thanks, Mom. So Kelsey or somebody from the team will be sending you an email with all the exam writing information. Yeah, perfect. That's a good point. Or at least the links to the exam writing information. But just to get a rough idea, and then you'll show your ID. This has been done this way for 4 or 5 years, maybe longer. I don't know. Some of you on the call might have written an exam like this, but lots of the online universities today, if you did a course through Athabasca or a course through University of Phoenix or something like that, they've been doing this kind of thing for a good long time. Yeah, so they'll want nothing on the walls, Mark, but not like completely devoid of anything. But it's, like a kitchen is typically a good place to do this, right? If you're going to write in an office, you're going to be better off to write in a client meeting room. Normally people, I don't have access to those client meeting rooms where it's one round desk and no other stuff, right? That kind of room would be good. If you're going to write in your normal office, you're probably going to have to clean it out a fair bit. Thanks. There's a list of exam centers. Okay. You with me, Mark? I know I would have to. I would have to clean out my office a fair bit. I got books all over the place in here. Okay, perfect. So you might be better off if you have a clean space in which to write. That's what they're going to look for. Okay. Yeah, just book a space in the office and go right there, right? I do think that for many people that'll be better. And all 3 big cities in New Brunswick have it. So Fredericton, Moncton, and St. John. I'm surprised at that, honestly. I don't know. Maybe I take it for granted, but it's never felt like that far a drive from those 3 cities to any of the other major centers. So whatever. Okay. All good? I'm not misremembering, am I? It's only like an hour from Fredericton to St. John, isn't it? All right. Yeah, some other instructions. Oh yeah, the exam, the do not disturb exam sign. So yeah. Okay, so you want to make sure that you're sort of well positioned for that, or just book to write in one of the exam centers. Okay. All right. Any other exam questions? I would book as soon as possible. Don't wait to book. Okay. You can book now and then provide your completion information later. That's perfectly fine. So you don't have to be done all components. Oh, thanks, Shauna. All right.
Now, what I would like to say, and this is Penny, is Kelsey and I will send out this information for you. It's a really nice thing that Kelly Becken from FP Canada sent to us, and she's our education liaison with FP Canada. So she looks after us. But if anybody doesn't get it, the onus will be on you to let Kelsey and me know I didn't get it. You forgot me. You have my wrong email. You don't like me. You don't want me to write the exam. You get the idea, guys? If you think I'm being a little sarcastic this morning, you're probably right.
So
I love you all, but I just want the onus to be on Kelsey, me, and you.
Okay, yes, it is. Ultimately, it's your exam. It is your responsibility to book it. Nobody else is going to book it for you. Okay. Unless you have a really great assistant, something like that, even then. All right, now yeah, so this is only for QAFP, Bonnie. If you're just rolling straight into advanced curriculum and you're gonna do PEP and all that kind of stuff, then this is not relevant. I don't believe there's anybody on this call who is writing the CFP exam in the fall. Okay, if you are, that exam registration is open too. I don't want to go down that path because it's such a one-off. Okay, all right. Are there any other exam-related points? Kelsey, do you have anything else?
No, nothing for me to add. Just the email that I will be sending out will have a timeline similar to what I had sent, I think, back in June. So I'll be providing an updated timeline and stuff too. So expect that email by the end of the day. Yeah.
Perfect. And Mom, anything else?
Yes, actually there is. I'm asking for a schedule change from everyone for Thursday, September 24th we have got day 21 or day 2 of unit 6. However you figure it out, because there's 22 days that you will have spent with Jason over core curriculum. I need to move that day to Friday, September 25th, because Jason has to be in Vancouver on Thursday, September 24th. Could everybody let Kelsey and me know if that's a problem, or if we can manage it this far ahead of time?
Can we chat about that? Okay. Can we chat about that before we put that question to the class?
We can, yeah, sorry.
Yeah, thanks. Okay, because I don't know if I actually have to be in Vancouver on the 22nd.
On the 24th. The 22nd is Calgary.
Yeah.
It's not that you have to be there. It's, did you want to be there?
Right, I don't want to talk about that here. So, yeah, okay.
Hey, we'll get back to you, class, but just so you know what I was thinking.
Okay. Yeah, go ahead with your question, Stephen. Yeah.
Yeah, just around timelines, I was planning to just go straight through for the CFP, but I know this is kind of my one-shot swing at it. So what kind of a detour would I take if I did consider doing the QAFP from our webinars and stuff, or would it just flow seamlessly through, or how's that look?
So are you lacking a degree, Stephen?
Yeah, I am.
Okay, yeah. So that's, now what has happened that might change your thought process is that, and Kelsey, I think, can help me out here, is that it used to be when you maybe first started down this path, you had to be done everything by end of 2021 to beat the degree requirement. But what's changed here is that FP Canada has said, no, in fact, if you get your QAFP done first, then we'll give you till the end of 2023 to be done your CFP.
Right, yeah. My understanding was I get a chance in June to write the first exam, and if I bomb that one, then I would have a rewrite opportunity in, is it late October or November?
That's right.
And then if I bomb that one, then I'm screwed. But basically the QAFP would give me kind of another full year to reschedule and try again.
Yeah, and I don't think it's worth, this is like a financial planning conversation. I don't think that you should only think about the possibility of failing the exam. That is one thing that can go wrong, but I've seen many other things go wrong. So, all the things you talk to your clients about in a financial planning scenario, somebody gets sick, something goes wrong in your business, we have a pandemic, right? Like everybody talks about in their financial planning scenarios. Something like that happens, and that pushes you again, right? So it's not only failing the exam that can happen, right? And in fact, one of the things that I want to warn people about in general, okay, and this is something that I warn about, I just want to be a little bit more aware of it this time than I normally would be, is that this is FP Canada's first time using this proctored software scenario. So it's actually ProctorU, which is a nice, healthy company in the exam environment space. They're not some startup fly-by-night type of thing. And they will know what they're doing, but there will be some of you on exam day, whether you're writing at home or in an exam center, who have technology challenges. This is a simple fact. And I think Penny and Kelsey and Omar can vouch for this. We have never seen an iteration of the exams from FP Canada where there wasn't somebody somewhere in the country who had a technology challenge, whether it was that they couldn't log in to write their exam, whether it was a power outage in the exam center, whether it was a server outage somewhere, okay? It is just what happens, okay? That's good. and it is, Paul, it is frustrating. Okay. It's a thing that happens. Yeah, that is a true story, Nicole. So that's why I like the QAFP route, because the QAFP route gets you some insurance. Okay. And as you may be aware, I am generally a fan of insurance, Nicole. All right. That's good. So yes, you can do QAFP. And what that does for you is it locks in progress. Okay, I believe, for those that are concerned about the regulatory changes, that that's going to meet your regulatory requirements. I do not know that. That is speculation on my part. Okay. You don't necessarily have to detour from the class. Stephen, you can write your QAFP while you're doing advanced curriculum. It wouldn't be the worst thing. It would put a little pressure on you. Okay, there is a QAFP prep. Yeah. Yeah, that's a true story, Sean. So there is the rewrite available. Okay. Yeah, that's good, Kelsey, thanks. Yeah. So QAFP locks in progress. It gives you 2 more years, assuming you pass QAFP, right? Okay. But really, you'll get up to 3 attempts at QAFP versus if you go the CFP route, you won't be writing until the spring of 2021. Okay, and that means only 2 attempts for those without a degree.
Well, now they have the January 2022 edition.
Oh, will that show up in their possible dates?
It should, my understanding, yes. Well, not yet. Oh,
I thought you had to be done everything. I thought now maybe you're right, Kelsey. Maybe you do get 1 more added in there. I would want to confirm that with David. Can you send David an email?
We've got a list of questions, Kelsey and Kelly and I, that we're sending off to Kelly and David.
Right. Yeah, it's degree, Carla. It's very explicitly a degree. Yeah. Okay. Yeah, that's true, Paul, but that doesn't really help this, right? Like you're still, so whatever, I saw that IG did change their take on this, but it doesn't change what FP Canada is doing. Okay. So you might have got more time from your employer, or from those who sponsor your license, but it doesn't give you more time with respect to the degree requirement. That's good.
And I just want to throw a little levity in here because Jason mentioned some reasons that you should write your QAFP. Some of this will apply to some of you and some to not, but the last person that got derailed from writing their exam had triplets. So there's good reasons that it will happen too, as well as bad reasons, but it still is a tough scenario.
Okay, so yeah, you want to take into account that it's a little bit of uncertainty around this, and I should not have to remind anybody on this call of uncertainty, right? We are living in the most uncertain of times. So, yeah, so CFP, yeah, so maybe there's a January 2022, right? Kelsey will confirm that. Okay, so you might have 3 attempts. Even then, it doesn't change anything because I would argue then that it gets you 1 more QAFP attempt if you needed it. Okay, because what's happening here, for what it's worth, is starting in 2022, there's going to be 3 exam iterations per year, which I think is a great change. Actually, I'm a big fan of this change. This really helps. It takes pressure off of students. Yeah, I'm a big fan of that. I really like that move. All right. Any questions there? Okay, perfect. Okay, so today we're going to look at the, and I would still, it doesn't matter the number of attempts. If you have a degree, Ryan, you have until the end of 2023. Well, actually, sorry, if you have a degree, whatever, there's nothing. You have 4 attempts at the exam, 4 attempts at each exam, sorry, and you have forever to get the thing done. Okay. Yeah, that's right, Stephen. If you finish your QAFP by the end of 2021, then you have until the end of 2023 for those absent a university degree to obtain CFP. Okay. That's good. If you have, yeah, most degrees qualify, Mike. I'm not sure what would make that a question, but you have to talk to FP Canada. FP Canada has a student support line. You can call them and confirm. Yeah. Yeah, QAFP basically is the CFP without the business owner stuff, Melanie. And yes, as of right now, Bonnie, I don't know if they're going to revise the exam post 2022, but as of right now, it's all multiple choice. Yeah, it's the same as the old level 1, Bonnie. Okay. All right. So yeah, QAFP, Melanie, is sort of designed for that person who's working in the sort of customer support, the tier 2 support role at the bank. You know, when people go to the bank and they have to open an RRSP, they have to do their first pack into a mutual fund, that kind of thing. They maybe have questions about a mortgage. That's what QAFP is designed for. Okay. All right. Info at FP Canada. All right. Okay.
Sorry, info, yeah.
Yeah. Okay. Yeah, so Mike, if you have questions about your degree for whatever reason, you can email them. What would make a question about a degree would be, I think they're okay with 3-year degrees, like if it's a BBA or whatever, I think they're good with that. But if it's from a foreign institution, that might be a question. Okay. All right. Perfect. And as I said, just get yourself registered, make your decision. Don't leave this as a lingering issue for a month or 2. Okay. The exam is going to fill up. All the exams are going to fill up. The longer you wait, the less choice you're going to have. Okay. Now, are there any content questions? Anything technical? Is that good for exam administration? There is, Stephen. The way they do it, if you cancel, they will refund you. I got to think about how this works. Sorry, I apologize. That's not it. If you postpone, because you wouldn't cancel, you would postpone, right? I sure am, Ryan. Yeah. Unless you know you're going the CFP route. So Ryan, you have a degree. You might have made a conscious decision to say, I'm not going to bother with QAFP. I'm just going to jump straight to CFP. And that's fine, right? That's fine. So this is part of the problem with a presentation like this. And you might remember if you go way, way back to day 1, we did the same talk. And it's this question of, you know, everybody on the call is in a different route. There are at least 4 different routes represented on this call. I want to say 750, Ksenia. Might be 650 early bird. It's in that ballpark. Might even be 550 early bird. I think Kelsey could tell us real quick. It's somewhere in that ballpark, plus $500, less $800.
Yeah, I can check.
Yeah, sure, thanks. Yeah, sorry, so the registration thing, the way it works, Stephen, is if you had to postpone, they'll charge you $100 to postpone. So you've paid your fee, you say, oh, I can't make it. It turns out I'm getting married in November. So that's where you would postpone. Okay. Yeah, the only downside is the cost, Ryan, right? That is the downside is the cost. Okay. So just more money out of your jeans. So, and I do think I still like the insurance aspect of it, Ryan, right? I still like that idea of locking in some progress. Okay. Thanks so much, Kelsey. Yeah. Okay. Perfect. And I've just seen too much go wrong. This call is a great example. There's about a third of the people on this call who started at some point and fell off and are now picking up again. Okay. There's folks on this call who lost track for health reasons or for family reasons or whatever. Okay. Yeah, it's true. You can pay $125 for the practice exam. I suppose I should talk about that for a moment here. Yeah, so FP Canada includes a completely optional practice exam. And I have mixed feelings about this practice exam. What I will tell you, so they're going to charge you $125 if you buy it with your exam. That's true, Paul. If you're self-employed, it's deductible. Okay, so $125 for the practice exam, or I think $175 if you buy after the fact. It might be $150, but I think it's $175 if you buy it as a separate purchase later. Okay, and I would say, so my approximate value here, I don't know if this is a useful metric, but I think it's worth somewhere around $75 or $80. If I were pricing it, what I think is fairly, that's about where I would price it. Okay? So the good things about this practice exam, what we like about it, is that it is like the exam-ish. I'll tell you why it's not in a moment. Okay, and it uses many old questions from the exam, although not exclusively old questions. There are some questions that are written by FP Canada staff. Either Ryan or Brian wrote questions for this exam. Thanks, there's all your dates. Okay, and yeah, so it uses all these old questions and it gives you a chance for one practice exam. Okay, what I don't like about it is that it's not enough like the exam. It lacks what I would say are some of the more difficult questions. Okay, and those who have gone through the testing on my site, you know what I'm talking about here. Okay, if you've gone through whatever, any of the multiple choice on my site, you have seen questions on there that might have you pulling out your hair. Okay, where you might be arguing that the answers are somehow subjective, which they are not, or you might say, I don't agree with Jason here, which is fine. I don't care about that, right? That's a second problem, but no, you do not. So the advanced curriculum, Sean, is criteria for the CFP exam, but not QAFP. Okay. All right, so the bad, it lacks difficult questions. Yeah, sure, Emily. So I'm actually going to talk about all the different exam prep tools that are available. I normally talk about that closer to the end of the course, where I'll go through the whole thing. I'm happy to plug Gobay. So the bad here is that it lacks difficult questions. It's only one exam. If you've ordered it before, so if you used it for a previous write, it is mostly unchanged. You might find 5 out of 100 questions are changed. And it's self-assessed, which is okay for multiple choice, but it's not sort of an assessed tool. So it's okay. All right. Yeah, so Bev, you do have to register on your own for IPE and QA, sorry, you mean PEP, right? You're asking about IPE or QAFP here. And Kelsey, help me out here. You can do IPE. You have to do IPE before you write the exam? I can never remember this path now. So everybody's going to have to do IP at some point. IP is just a tiny little course, 3 hours. You'll be done in an afternoon. But yeah, you'll have to do IPE. I just don't remember the path to certification here. Let me just check real quick here. I know you can do PEP after the fact. Yeah, you have to do IPE first. So yeah, before the exam. And it's $175 if I remember right. Takes about 3 hours. It's all online. And it's done with it.
200 if you buy it alone. If you buy it with the PEP, then it reduces down to $150, but you pay $1,500 for the PEP.
Yeah, and I don't know if I would register for PEP just yet. I think you want to figure out what you're doing for a PEP. Okay. The problem with registering for it concurrently with PEP is you can't register for PEP for the CFP until you're done the advanced curriculum. And if you're planning to do the CFP, I would suggest there's no point in doing the QAFP version of the PEP. So I'm going to just say do the $200 version. Yeah, you're out $50 because of it, but I think it's the right decision. Okay. All right. Okay. No, don't pick the package. Don't pick the package. Pick the $200 version, Bev. Okay. If you pick the package, you're making a decision about something that you're not prepared to make a decision about yet. Okay. Just sign up for that. Good? Because honestly, you won't really know what route to go until you're right and past QAFP. What I would suggest is, and this again goes way back to day one, but what I would suggest here is if you're pursuing, yeah, we do, Melanie. Yeah, that's going to show up in Kelsey's email to you. Yes. So if you're pursuing CFP, right, remember the path here is going to be that you're going to pass your QAFP, including having completed IPE. So you're going to pass that QAFP, then you're going to do advanced curriculum, or maybe somewhere along the way you'll have done it. So if you stay on the path with us, you'll be doing that at the end of October. So call that concurrent or roughly concurrent. That's good. Then you'll do the CFP PEP, okay? Not the QAFP PEP. Don't do the QAFP PEP if you're pursuing CFP. They don't have the bridging class yet. There's supposed to be a bridging class later on that shows up that allows you to bridge from QAFP to CFP, okay? And then you're gonna do your CFP exam, okay? That's good. Three to 4 hours, Melanie. You see it on the top right corner there? Okay. Yes, that's true, Todd. Before you can, you have to have everything done to get to the CFP exam. Yeah. Okay, but Bev, only if you're intending to stop at QAFP. Oh, PEP is about 120 hours for the CFP PEP. Okay. No, you can, Todd. Okay. I feel like now we're down the path of exactly where we were on day one. I feel like everybody's got to go back and watch that first hour of day one. Okay. I keep trying to say this. There are so many different paths. It becomes impossible to address this for every single person. Okay. The QAFP is optional. Okay.
And if anyone has questions, please pick up the phone, not today during class, and call Kelsey. That's what she's here for.
Yeah. Okay. Right. Remember the whole risk management discussion, Todd? That's your insurance. QAFP's insurance. Okay, perfect. Okay. Are we good there? All right, perfect. It is confusing. I know it's confusing. Okay, it's hard to keep track. And the number of different paths and the changes that are coming because of the introduction of the degree and diploma requirements really mess this up. It makes it hard to know what you're supposed to do. Don't feel bad about having questions about it. Okay. What? This is the best stuff, Paul. All right. This is where we get to learn all that we don't know about RRSP. So on that note, let's move on to the RRSP. Okay. So we're going to talk about RRSP and how we use the RRSP. We're going to make sure that we cover off all the appropriate details here. We're going to really dig into it. Okay. Yeah, that is 100% the case, Stephen. You're exactly right. Okay. So this morning, RRSP and RRIF. This afternoon, pensions. Okay. Yeah, exactly, Mark. Yeah. Okay. All right. That's it, Stephen, right? Okay. Same schedule as per. Okay, let's get into the RRSP. So first off, where does this thing come from? What really happened here was prior to 1956, many Canadians, in fact, most working Canadians, had access to a workplace pension plan. Okay, and the way these workplace pension plans worked was you had employer who would contribute, maybe the employee would contribute, but many of them were non-contributory plans. Okay, would contribute, the contributions would be tax deductible, and then you would have a taxable pension at retirement. That's it, okay? This is what we would refer to today as a defined benefit plan. You didn't even need that language in 1956 because it's really just what happened, okay? It's what people had. And that had been the way since roughly, and it depends where we look, but the late 1800s to the early 1900s is when we saw these introduced into employment situations. Okay, so this is when we start to have this sort of what we often call a paternalistic approach to employee management. The idea was that the employer was going to take care of you, provide health benefits, pension benefits, and so forth. Even there's a whole bunch of economic theory around the benefit for the employer of providing an employee with education. Okay, so all this kind of stuff really exists in this DB world, but what we're starting to see by the mid-1950s is we do get some employees who don't have a workplace pension. Okay, and because of the absence of that workplace pension, we say, well, for employees at smaller businesses, or for employees who, or for people who are self-employed, or for people who are more transitional in their employment, we need a way for them to participate in workplace savings, okay, or in a workplace savings type plan. Okay, now honestly, and I know that we don't like to hear this, but some of this flows out of our neighbors to the south. So this is right about the time the US introduces into its Internal Revenue Code its 401k series of plans, which are essentially the same as the RRSP. Okay, there are some differences, but there's a whole bunch of, and there's not just 401k, there's 401m and 401l, and then the 403 series of plans, but they're all essentially the same thing. So this is where Canadian policy folks look at this and say, you know, that actually looks like a good idea. The US workforce looks very much like the Canadian workforce, and therefore we're going to introduce this in Canada. And so what we end up with here is the introduction. So in 1956, we have the introduction of the RRSP, which shows up in section 146 of the Income Tax Act. And really is originally an insurance plan. Okay, originally the idea here is that this goes into insurance discussions where we talk about, and I know some of you remember this from, say, your LLQP, we talk about risk of premature death, risk of disability, and risk of living too long or outliving your money. Okay, so what ends up happening here is life insurance folks, and you would find shops like Sun Life or Freedom 55 Financial or London Life then would have been where you would go to get sort of your one-stop shop for all of this stuff. So you'd buy life insurance, you would buy, although in these days, your disability insurance would have been handled mostly through your employee group benefits. We didn't really have disability insurance as an individual product in Canada until the mid-1960s. And your risk of living too long would have been handled mostly by deferred annuities, which is very much like, for those that are at Sun today, that's very much like the accumulation annuities that you have on your product shelf at Sun Life. Basically, you would invest here in a product with a guaranteed return. We didn't see variable returns here until later on. And then at retirement age, which was age 71, later on the age changed to 69 and then back to 71. But at age 71 latest, you would annuitize that deferred annuity, basically turning it into a stream of lifetime retirement income. Okay, that's all good? Okay, so what happens with your RRSP, we have your plan sponsor or trustee, and that's going to be an insurer or an investment dealer. And they're going to hold your investments in trust for you, and then they register the plan with CRA. And the fact that the plan is registered and your participation in the plan is registered, that's what allows then CRA to track things like your deduction limit. And over contributions and all the issues that go along with having a plan like this where you can't contribute an unlimited amount of money without penalty. Okay. Any questions there? Does that match our understanding? And in fact, when we look at the language around the RSP, you're going to see what I'm talking about with this insurance language. Do you remember in chapter 12, we talked about the three parties to an insurance contract? Everybody remember this? We had our insured, our insurer, and our life insured or our annuitant. Remember that? And I said in a two-party contract, that's where my insured and my annuitant are the same person, right? If I take out life insurance on my own life, then my life insured and annuitant are the same person. Okay, well, we also had the ability to name a beneficiary. We have exactly the same thing with an RRSP, okay? So when you look at an RRSP, you have an annuitant. That's the person who will ultimately draw income from the plan. Okay. And we're going to have a beneficiary. That's if the annuitant dies, who gets the benefit. Okay. And then also with the RRSP, when you make a contribution to it, the proper name in the Income Tax Act for a contribution is not a contribution. Anybody know what the Income Tax Act calls the money you put into an RRSP? No? What if it were an insurance contract? That's it. It's premiums. That's the amount you pay into to an RRSP, okay? To the extent that when you have a death benefit paid here, it's actually called a return of premiums. That's your RRSP death benefit. Okay, so we very much see that insurance language here. It really was originally intended or originally structured as an insurance product. And it wasn't until, and we'll talk about this on the next slide, it wasn't until the sort of mid to late 70s that we started to see folks who are more on the investment side doing RRSP work. Okay. Any questions or comments there? All right, perfect. Okay, so now we're going to look at sort of a flow chart here for my RRSP. Okay, so my first question here, or the first concept we'll cover, is our contributions to an RRSP. So who can contribute to an RRSP? What has to happen in order for you to be able to contribute to an RRSP? Okay, perfect. You have to have earned income. And that earned income, we take your earned income times 18%, and that gives us your RRSP deduction limit. Okay, which you'll notice is not the same as a contribution limit. You can contribute more than this, but that's all you can deduct. Okay, now your RRSP deduction limit for 2020 is $27,230. Okay, for 2021, we already know the deduction limit. It will be $27,830. This amount is indexed to inflation. And it hasn't always been the case. We had a long run when the RRSP was first introduced. This figure was $7,500 with no indexing. And then from the late 70s until the early 90s, it was $13,500 with no indexing. And then it was $18,000 for a very long time with no indexing. Today it's indexed. Okay. That's good. Yeah, that's right, Ryan. Yeah, we sort of did. Now TFSA is indexed, right? So now TFSA is properly indexed, and you know one day it will be a $6,500 contribution limit to TFSA, right? Okay. The difference with TFSA, which I actually think is good, with TFSA, they rounded it off, right? So there's a shadow figure for TFSA. So whatever it is today, I don't know. The shadow figure might be $6,240. Once it breaks $6,250, that's when it rounds up to $6,500. Okay. So TFSA is indexed, but it's indexed and rounded to 500. Okay. Whereas RRSP, they've just rounded it to the $10. Okay. So this is your deduction limit. Now, in fact, there is neither a minimum age nor a maximum age at which to contribute to an RRSP. I know several of you represent institutions that won't allow a child to open a plan, but that is not a requirement of the Income Tax Act. So there is no minimum or maximum age at which to contribute or participate in an RRSP. If you had a 16-year-old who wanted to open an RRSP account, they probably couldn't do it with most of the folks on this call, but who can I pick on here? I think, Bev, if that person came to see you, yeah, that's true. You're getting deduction limit as long as you're filing a tax return, as long as you have earned income. That's exactly right. And if your kid at 16 wanted to open an RRSP, they could go to a credit union. They could open an RRSP, probably using a savings account. Yeah, exactly, Bonnie. Not mutual funds, but a savings account would work perfectly fine here. That's good. So it can be done. The restriction you have is a property ownership restriction, not an RRSP restriction. Okay, now that being said, I said no maximum age either. So what's the age limit we normally think about with the RRSP? 71, right? So the rule here is that I cannot own an RRSP after December 31st of the year in which I turn 71. Agreed? However, I can still contribute to an RRSP after that point, just not mine. Whose RRSP can you contribute to? Exactly right. So over the age of 71, if you have a younger spouse, okay, and why wouldn't you? It's my story, it can be whatever I want. So if you have a younger spouse, you can contribute to that person's RRSP. Okay, now we'll talk about spousal RRSP contributions in a few slides. We'll cover off all the appropriate details here. All right. Okay, so the big benefit here, you're only allowed under the Income Tax Act, Stephen, one spouse. All right. So, okay. That's true. One spouse at a time, Philip. That's a good point. Okay, so what happens when you make this contribution to the RRSP? Then you have a tax deductible contribution, which reduces your taxable income. You can full of shade, yeah, absolutely. Okay, and we'll talk, like I said, we'll talk all about that spousal RRSP. I have a specific slide for that. We'll delve into the whole thing. Okay, but there's no restriction around that, yeah. All right, now I will mention, just because it's a question that sometimes comes up, if you're a non-resident, and this is a little bit of an obscure point. So if you're a non-resident with RRSP room from a past year, so you were a resident of Canada past year, you still have RRSP room, you can contribute but you cannot deduct your contributions. Okay, so then when you have money sitting in this RRSP, of course, the second advantage beyond the tax deduction is that you have tax deductible growth, or tax deferred growth, sorry. Okay, and I will not accept the language here, and this is the kind of thing that would be incorrect on an exam, or if you stated to a client or anything like that. It is not tax-free. Okay, it is tax deferred growth or tax deferred gains, but it is not tax-free. Okay, what kind of plan has tax-free growth? It's right in the name, right? The TFSA. Perfect. Okay, so I have tax deferred growth or tax deferred gains here. Now, I have a wide range of possible investments. There are many possible investments here. Okay. Oh no. There we go. That was ugly. All right. Many possible investments. Most of the stuff we looked at in chapters 10 and 11. Okay. So you could have stocks, bonds, you could have a GIC, a savings account, even a checking account if you wanted. You could have mutual funds, ETFs, seg funds. You can have most kinds of derivatives. You can have silver and gold certificates. Okay, you can hold a mortgage under some conditions. Yeah, we're going to talk about the mortgage on the next slide, Todd. Okay. Generally, the stuff that you cannot hold. Okay, the stuff you cannot hold. You can't have physical currency. So I can't have a briefcase full of cash in my RRSP. That's good. I can have a cash position. So I can't exactly, Todd, I can't hold derivatives where the chance of a loss is infinite, which mostly refers to puts. I can't hold art and collectibles. I can't have my wine collection, my stamp collection, my group of 7 paintings. None of that can sit in my RRSP. That's good. Mention here that my mortgages are conditional. There's a bunch of stuff you have to do in order to hold a mortgage. It really has to be a mortgage on your own property, although I can hold mortgage mutual funds as well. All right. I'm here for you, Stephen. All right. That's all good? Oh, I can't hold jewelry or gold. That type of thing. So really nothing where there's a significant chance of loss due to something other than just investment activity. Okay. Yeah, I do, Sean. I do. All right. Okay. That's true, Paul. Yes, I can't hold direct real estate. You're exactly right. Okay, so I can't have an actual physical building in my RRSP. Okay. However, to Sean's point, I can buy a mutual fund that invests in RRSP, or I could buy a REIT. Things like that can be held here. Okay. But no direct real estate holdings. All right. That's all good? Now, when can I take money out of my RRSP? Okay, so I can withdraw anytime. Assuming the underlying investment is liquid, the RRSP itself does not impose any restrictions. Now, there are two means by which I can withdraw with no tax consequence or no immediate tax consequence. And what are those? Home buyer's plan. And the other very similar plan, the lifelong learning plan, which both of which we'll talk about in a later slide. So home buyer's plan and lifelong learning plan allow withdrawals with no immediate tax consequence. Okay, but otherwise, there is a withholding tax. It's a taxable withdrawal. And those attract a withholding tax. Okay, and this is a memorize item. So there are two memorize items on this page. One of them I bet that everybody knows already, and that's the 18%. That is a memorize item. Okay, you probably don't have to know the exact deduction limit for the current year, but you sure should know the 18%. If there's anybody on the call who didn't already know the 18%, I will be shocked. Okay. And the other thing that you have to memorize here is your withholding tax rates. So what are the withholding tax rates outside of Quebec? These rates are different in Quebec. Don't worry about that. But in all other provinces, what are the withholding tax rates? 10, 20, 30, yeah, that's it. So it's 10% on your first $5,000 of withdrawals, 20% on a withdrawal from 5,001, sorry, I don't have that phrased right. It's 10% on a withdrawal up to $5,000. Okay, from 5,001 to $15,000. Okay, and then it is 30% on withdrawals over $15,000. Okay. It's true, Paul. Paul's exactly right here. You can ask for a higher rate of withholding. You don't have to. It's the total withdrawal, Stephen, exactly right. So what would happen here is if you took, let's say, 3 withdrawals of $2,000, okay, in 1 year. You with me here? On the first withdrawal, okay, there's going to be a little math here. We're ready for some math. So on the first withdrawal, you do $2,000 times 10%. Your minimum withholding tax would be $200. Everybody agree with that? That's easy, right? Your second withdrawal, yeah, 100%, Ryan. We'll come back to that in a moment here. So on your second withdrawal, you're going to have $200 minimum withholding tax, okay? Your third withdrawal is going to put you over $5,000. Okay, and because of that, it's really $6,000 times 20%. So your withdrawal here is a $1,200 total minimum withholding tax. Does everybody see that? Is everybody with me on that $1,200? Okay, so in fact, what's really going to happen here, okay, so Shay, do you agree that we're now at a total of $6,000? Does everybody agree with that? Right, and I will talk about that possibility in a second, Sean, but this is how the Income Tax Act is written, okay? Okay. So at this point, because that's not how it's written, Nicole, and I wrote it properly up here. It's 20% on withdrawals from 5,001 to 15,000. Okay, that is exactly what it is. So a withdrawal of $6,000 is a withdrawal between 5,001 and $15,000. Therefore, it's a 20% withholding tax. It's not a marginal tax. Well, you can think that, but that will be incorrect. Okay. It's not a marginal tax. Okay. So now you have to go back and unlearn what you know about marginal tax. Okay. Yeah. And it's an easy, that's why I'm showing this example, Nicole, right? It's an easy place to be confused around. And in fact, what happens in practice, I think, amplifies this confusion, which I'll come back and talk about in a moment. Okay. Which ties into the comment Ryan had a minute ago about multiple institutions. So at this point, that's exactly it, Nicole. So we've already withheld $400. Does everybody agree with that? That's kind of the case, Carla. Yeah. Okay. So I've already withheld $400, and I need then another $800 withheld on this $2,000 withdrawal. Okay, which would total $1,200 then. So now, across the board, my total rate of withholding is 20%. Okay. Now, what Mark points out here is correct. Okay. If you're on a, let's say for the sake of argument, I'm on a a pre-authorized income plan where it's paying me $2,000 a month, then once I hit that higher threshold, I'm going to hit that next level. Okay. Occasionally, you'll find an institution who doesn't do this properly. The Income Tax Act actually puts the burden on the institution to do this right. So what is supposed to happen is if you have a client who comes to see you in January for the first $2,000, and then they come back and see you in May for the next $2,000, and then they come back and see you in October for the next $2,000, okay? Many institutions will not do this properly, but the Income Tax Act says the institution is supposed to get you to that 20%. So what you're explaining, Nicole, is not a surprise to me. Okay, but properly, the Income Tax Act is very clear on this and does impose a burden on the institution to apply the withholding tax correctly. Now, where you have withdrawals from multiple institutions, there's no way for those institutions to know what any other institution has done, so there's not an opportunity there to get it right. Okay, and it is the point, Carla. Yeah, that's right. That's why we have that withholding tax. It's supposed to be something of a, I don't know about disincentive, but we want to make sure that we're capturing people who are in a taxable position and not giving them a huge tax bill at the end of the year. Okay. Yeah, it's true, Mark. There are situations when lower income earners can get a legitimate benefit from an early RRSP withdrawal. Okay. And that's where I would be more concerned about withholding tax. That's where withholding tax can be an unnecessary burden. Okay. Now, I know today, so your story, Nicole, about, you said this was a couple of years ago, right? Your withdrawal? Where you didn't have to deal with the, or where your advisor said you don't have to do the 10, 20, 30 thing. If you take smaller withdrawals, you could parse that out a little bit, right? That is less likely today. More institutions are getting compliant with this as their systems get better. Okay. Everybody's good there? So Stephen, if you had a client who came to see you where you're trying to minimize withholding tax, before you tell that person, take 5 withdrawals at $2,000 each instead of 1 at $10,000, make sure that that's actually how Sun is going to treat it, okay? Or SLGI or CI or whomever you deal with, okay? That's good? All right. In fact, there was so much poor adherence to this. This is way, way back. This is 9 years ago now. But in 2011, when Jim Flaherty was still alive and still the finance minister, he wrote a letter to the 800 or so institutions that manage RRSPs for their clients and said, hey, dummies, you're doing this wrong, get it fixed. Okay? That's a paraphrase. He may not have said exactly that. All right, that's good. Yeah, that's true, Mark, and that can be a painful lesson learned, right? No, withholding is completely optional on Canada Pension Plan. Yeah, and that's the same point, Philip, right? Your point and Mark's point are essentially the same point. You have this person who's generating income. They're going to have to pay tax on it. If you plan for it well, minimizing your withholding tax can be an advantage, but most people don't have a plan to pay the real tax that's going to be due come April of next year. Okay, and that's where you end up with a sort of spiral here, Philip, right? Where, oh, I took money out of my RRSP or my RRIF, and now I'm April of next year, and I have a tax bill, and I got to take more money out of my RRSP or my RRIF to pay the tax, and now you don't take withholding tax again, and you end up with this nightmare, right? So it is, and this is why we did that work back in Chapter 7, okay? That we need to understand the full consequences of a withdrawal from this plan, okay? Yeah, that's it, Stephen, right? You are better off to minimize your withholding taxes if you're good and disciplined, if you can actually do something productive with that money, and you're going to have the dollars to pay your withholding tax, or sorry, your unpaid tax come April, okay? That's true, Todd. Potentially loss of room is a problem here, depending what you're doing, right? Okay, and I do agree with you, Bonnie. A lot of people look at that withholding tax and think it's double taxation or something like that, which it absolutely is not. All right. Yeah, that would be differentiate. Exactly, yes. Because then you took out only 4,000 in 1 year and 2,000 the year following. So yes, then everything would be at 10%. That's where my example is in that year, right? Yeah, you could, Esther. I think you really have to be very careful about withdrawing from your RRSP to contribute to your TFSA. And that's where loss of RRSP room to me is something to concern myself with. I don't know if I'm necessarily a big fan of that strategy until I know a lot more. Okay. 100%, Mark. Yes. Okay. Which is why, and I know a lot of you found it painful, but that's why I dragged people through that Pearl tax table exercise back in Chapter 9. Because it really gives you the opportunity to apply tax brackets in a close to real life scenario. Okay, that's good. Okay, perfect. Because I don't think it's unique to clients, Mark. I definitely know financial advisors who do not understand how tax brackets work. All right, which is why we're here, right? Because we all have something to learn. Okay, so now, yeah, absolutely, Philip. And that goes back to, again, a good financial advisor who can advise that person on the full consequences of their various financial decisions, right? Okay, so my tax deferred growth here. Okay. It's true, Stephen. It is a good reason to consolidate. Yeah, much easier to have good advice that way. So with my tax deferred growth, okay, here's what's going to happen. I must no later, okay, no later than December 31st of the year I turned 71, I can no longer have and RRSP. Is that fair? Nice. Okay. So then, what are my choices here? Yes, exactly. Esther, I think we have different views of diversification here, right? There are three things that can be done so that I no longer have this RRSP as of December 31st of the year I turned 71. Okay, the RRIF. So that's today, that's sort of the default option. That's what most people are going to choose, the Registered Retirement Income Fund. The RRIF, okay. And the RRIF basically, yeah, perfect, Philip, we'll come back to the annuity in a moment. The RRIF basically has the same characteristics as the RRSP, except that I cannot make any more contributions, okay? And there's no home buyer's plan or lifelong learning plan, okay? And now I have the same investments as I did with my RRSP. I generally just continue to have the same investments. And exactly that, Stephen, I'm subject to an annual minimum withdrawal, which we'll talk about quite a bit later on this morning. Okay, but there is an annual minimum withdrawal out of that RRIF. So I have to clean it out over the sort of span of my retirement. Now, this was only introduced, and this goes back to my history lesson on the last page, this was only introduced in 1978. Prior to 1978, there was no RRIF. And what happened then, prior to 1978, is you would do what Philip suggested, you would annuitize your RRSP. Okay, which you can still do, but nobody does. Okay, and the idea here is that you just use the funds in your RRSP to buy an annuity. Okay, and in both cases, with the RRIF and with the annuitized RRSP, whatever income you take, so that annual income, the full amount of annual income is taxable. Okay, but you still have tax deferral on the invested principal. Okay, so only the withdrawals are taxable, but your investment income is still not taxable. Okay, just like the RRSP. And then, and we'll talk about withholding tax and the RRIF and how that works out in a few minutes, in quite a while actually. And of course, yes, Paul's quite right here. There is a third option, which is generally not attractive, but there are situations when this makes sense. So you can just take the full amount as cash, okay? And then that would be fully taxable. And this can make sense. For example, if you have somebody, and this is my easiest example of this, somebody who retires at age 71 and the only RSP they have, maybe they have a $20,000 RSP, maybe an old group RSP, something like that. If they keep it, they have to RRIF, okay? And then it would ruin their RRIF withdrawals, will hurt their GIS. If this is all this person has for retirement savings, they're probably collecting GIS. So it's going to be taxable, but also they're going to be at the high rate of GIS withdrawals up to 75 cents of GIS lost per dollar of RRIF income. Okay, So we don't even care about the tax here. You care that if you've got this person who retires with this tiny little RRSP and they're going to use GIS as a big part of their retirement income, they're really going to get hammered on those withdrawals. Okay. So I would suggest for people who have somewhere less than $100,000, it's going to vary, but somewhere less than $100,000 in their RRSPs in total at retirement, it is often worth just cleaning the whole thing out. Okay. That's all good? Yeah, but if you're not paying any tax, Mark, you don't care about the pension credit, right? So if you're in the situation I described here where you're collecting GIS, you're not a taxpayer anymore. So the pension credit does not help. Yeah, exactly, Paul. So you might give up 1 year of GIS, but then you're going to get 15 years of better GIS in exchange for that, right? Yeah, so Stephen, this is where it's going to depend to some extent on relationships, okay? The accountant is going to be very much focused on the current year. The financial advisor tends to have a better long-term view of this. Okay, yeah, that's exactly perfect, Philip, right? That's a very case-by-case situation, right? So that's a great example, okay? So if you have a client who gets advice about their RSP from their accountant, and you say, oh, that's the wrong advice, client, why don't you do this? Okay, I would suggest that if that's the first time anything like this has been discussed, that 70 or 80% of the time, the client is going to take the accountant's advice over yours. Okay. But, and I think Paul is right here, I think the real key here is that this is not the first time you've talked to the client's accountant. Okay. So if you have a client who's working with a tax professional, I think it stands in the financial advisor and the client's benefit and the accountant's benefit as well, that you open up that relationship as early as possible. Okay, so the first time you should be talking to your client's accountant about their RRSP should not be in October of the year that person is turning 71. Okay, it should be when they're 52 and you and the accountant sit down together to come up with a tax plan. And that doesn't have to be a big, long discussion. That can probably be a 10 or 15-minute phone call, maybe a couple of emails afterwards. So if you position this properly, it makes a big difference. But if you surprise the accountant, like I said, in October, the year the client turns 71, you're going to get a bad answer. And you deserve to get a bad answer. Okay, is that fair? That's the key here, isn't it, Paul, when you talk about recommending it properly to the accountant? It's really about developing that relationship early. Okay. T4 for their TFSA. Wow. Okay, super. That doesn't make any sense at all. Okay. Now, my one last item on this slide is to point out, I talked about these being the investment options for the RSP. This is generally the same as the whole alphabet soup of investments. Okay, so RRIF, LIF, LIRA are all the same. Okay, TFSA, DPSP, RESP, RDSP. If you want to get proper here, PRIF and PRIF, depending if you're in Saskatchewan or Manitoba. And I'm missing one here, PRPP. Okay, good. Oh, yeah, IPP. I could put IPP in here too. All right, yes, okay. So generally the same as, though it's not perfect, that's not perfect, but that's generally the same. Okay. And we'll talk about most of those plans at some point in this course. We won't actually talk about the IPP. It's in the textbook, but we won't talk about it until advanced curriculum. I can't remember where we talk about PRPP, sorry. All right, that's all good. If you don't know about PRPP, that's fine. Nobody does, nobody has one, okay, outside of Quebec. Yeah, it's a true story, Cam. You can, if you're not yet 71 and you've RIFed already, you can convert your RIF back to RRSP perfectly fine. Yeah. Okay. It's just income shade. So it just adds to your, there's no tax rate on it. It's just income. Okay. So when I say the full amount is taxable, it just gets added into that income calculation. Good. So if you're in Saskatchewan and you take less than $46,000 of income, it's going to be taxed at 26%. Okay. If you're in Saskatchewan and you take $70,000 of income, the first $46,000 is going to be taxed at 26%, and the next $24,000 is going to be taxed at 35%. Okay. Again, same rule here, Bev. Yeah, same rule is that if you're not yet 71, you generally can change a lift back to a lira. Now, if you've unlocked it, Bev, there's a little bit more restriction there. Okay, we haven't talked about unlocking it all yet because we haven't talked about locking in, but depending on whether you're in an unlocking jurisdiction, there are some different rules there. Okay. Okay, yeah, we haven't talked about unlocking at all yet, and that's not really the same thing here, right? So, okay. Yes, because you're in BC, Todd. Of course, you know this is quite a bit different in BC. Okay, so this is very similar. We're going to talk about these later on to your LIF, and your RRSP is very similar to your lira. Okay, and in fact, later on when we introduce the LIF and lira, I'm going to use a very similar flow chart. Okay. Perfect. Are there any questions about anything that's on this page? I know there's a whole bunch of stuff we still have to talk about. We have a whole morning to talk about it, but I want to make sure that we're good with what we see here. Okay, so if you contribute more than your deduction limit, Roxanne, you can't deduct it, okay? And then there is an overcontribution allowance. We'll talk about that in a few slides. So you can always contribute whatever you want. However, you're going to have penalties for doing so. Okay. All right. So that's where properly we refer to a deduction limit and then later on an overcontribution allowance. All right. Now you can contribute to your RRSP and not deduct it. You can wait and save your deductions for a future year. Okay. You just never know. No, you don't, Stephen. All right. Okay, like I said, I know advisors who don't know how tax rates work. All right, I'm going to go down a little bit of a garden path here, and we're going to talk about the RSP and the mortgage. So this is where I don't care. I actually am not a fan of this strategy. For what it's worth, I think hardly anybody is ever well served by what I'm about to show you. That's not my point, okay? My point here is really to show you what the RRSP is. Okay, so here is my scenario. I have a, let's say an executive, Okay, and my executive lives in Regina. Okay, and this person is age 55, and they have an RRSP worth $1.2 million. They got an RRSP for $1.2 million. It's all in mutual funds right now. Okay, that's good. They own their home, and the home is worth $600,000, and they have no mortgage. Okay, that all makes sense? And Sean, my $600,000 house in Regina, pretty nice house, right? I'm going to be down by Wascana, down by the legislature there, right? What's that neighborhood called? Just off of Albert. All right. You know what I'm talking about anyways, right? So, perfect. That's what I'm looking for, Sean. Yes, thank you. So now this person gets relocated to, let's say, the Lower Mainland. Okay. And Todd, your $600,000 of house value in Regina is going to turn into potentially a little shoebox of a place. Best case scenario, maybe out in, probably Surrey, right? And not South Surrey, right? I can probably get into a little condo in South or in North Surrey. Yeah. Okay. So they want the same kind of house. So here's what's going to happen. Okay. They are going to, and I'm not suggesting this is a good plan. I don't want anybody to misconstrue this as financial advice. I am only showing you what's possible. All right. So they find, now they have $600,000 free and clear. And let's go with Todd's estimate. They find a $1.5 million house to purchase in the Lower Mainland. Okay. Similar sort of place to what they had in Regina. And they don't want to take out a mortgage. They don't want to be beholden to a bank for whatever reason. So within their RRSP, what's going to happen here is they're going to move $1 million. So we're going to move $900,000 to cash. It's not a withdrawal. Okay, they're just in a cash position. Is everybody with me there? And they're going to keep $600,000 invested in mutual funds, whatever your investment dealer calls it, Stephen. That's I believe, an SLGI term. Okay. Oh, it was 1.2. Thanks. Yes, perfect. That's where I couldn't see my math. Okay. Thanks, Philip. All right. So they're going to keep $300,000 invested in mutual funds. So we're not going to worry about that now. We're just going to deal with the $900,000. So here's what happens. They make a $600,000 down payment. And now they need a $900,000 mortgage. Okay. Everybody's good? This makes sense? So let's say for the sake of argument, they bank at BMO. So they do their banking at BMO. So one thing they could do, they could go to BMO and take out a $900,000 mortgage, and they'll likely qualify for it. Should be no problem here. With that big fat down payment, they should be in good shape. So they could go to BMO and take a $900,000 mortgage. And let's say, I don't know what we're at today on mortgage rates, roughly 2%, right? 2.4, something like that. Somebody give me a mortgage rate here. 5-year fixed, 2.3, 2.4. All right, fine, I'll make it up, 2.4, unless somebody wants to correct me. So take out a $900,000 mortgage at 2.4%, but they don't want to pay interest to the bank. Okay, so instead, what they are going to do, their RRSP is going to extend them a mortgage. So instead of using BMO, okay, their RRSP is going to be the mortgage provider. And this is okay. This is a permitted investment as long as you're using the home for personal use. Okay, so you can't do this for a pure investment property, but you can do this for a house you're going to live in or a vacation property. Yeah, so my 5-year fixed at 2.4, Todd, close enough, right? We're okay with that? I'm just going to, okay, perfect. So, so their own RSP. So what's going to happen here is they'll get their banker at BMO to write up a mortgage agreement for them. And basically, we're just going to use the normal BMO boilerplate. And everywhere that it says BMO, we're going to cross off BMO and replace that with my RRSP. Is everybody with me there? Okay, so now as they make mortgage payments, and this is where people often get confused around this. This is not an RRSP contribution. Their mortgage payments are not an RRSP contribution. Essentially what's happened here is now their mortgage, sorry, now their RRSP, I apologize, holds $300,000 of mutual funds, just like it did a minute ago. And the other investment it has is a $900,000 mortgage. Okay, that's an investment, isn't it? If I loan somebody $900,000 under a mortgage and they're going to buy a house with it, that is an investment. Okay. Does everybody agree with that? Yeah, it's not liquid to the RRSP, or at least it's not directly liquid, but it's okay. You could, in theory, sell that mortgage, Ryan, right? Okay, so what's going to happen here? Yeah, honestly, Cam, probably BMO is only going to do this if they hold the RRSP. Okay. They don't, there's no legal requirement around that, but they're probably only going to do this if you have the RRSP with them. Okay, well, I think the bigger hitch is that it's just not a good deal. All right, that would be my bigger hitch here. So now, as they pay principal and interest on the mortgage, so this is going to be exactly the same as if you're at a third party paying this. Okay, right, nobody's going to do it for free, right? So as they pay principal and interest on the mortgage, that's their return their RRSP generates. Okay, so for example, if it's a fixed 5-year rate at 2.4%, that's the return your RRSP is getting. Okay, but your principal and interest, it's not RRSP contributions. All you're doing is gradually reducing the value of the mortgage to your RRSP and replacing it with cash. That's right. And then that cash might go back into mutual funds or whatever else. Okay. Yeah, that's what you're doing. Your mortgage payment is going into your own RRSP. So instead of stroking a check to BMO, you're stroking a check into your own RRSP. All right. Does that all make sense? Yeah, sorry, Esther, didn't we just had that question. It doesn't legally have to be with BMO, but probably BMO is only going to do this deal if they hold the account. Okay, no, that's okay, yeah. So well, I wouldn't say it's creating cash, Carla, but what's happening here is you're replacing your mortgage. Do you see this? With cash, right? So if whatever, let's say the first payment is $1,000 payment. With me here? Yeah, it's just a different investment, exactly. So the first investment pays down $1,000 of principal. I now have an $899,000 mortgage position and $1,000 of cash plus the interest on that, right? You with me there? Okay, so it's not, there's no magic here, right? There's not any, like I said at the very beginning, at least twice, I'm not recommending this. I'm only showing you how it works. And really, I don't even care that much about the mortgage. I care that you understand that your RRSP is just a place to hold investments. Okay, that's good. And that's all we're doing here, right? I had mutual funds, now I have a mortgage, then I'm gonna have cash. That's it. But I am missing out on the return in the market, Melanie, right? Because I have $900,000 that was sitting in mutual funds, which no longer is. Right. So I'm giving up market returns or market risk, if you want, in exchange for that 2.4% return. Yes, that's my next comment here, Roxanne. Okay. All right. Yeah, it has to be not principal residence, Stephen, but a place for personal use. Okay. Okay. So it's nothing to do with the principal residence rules. Don't confuse that issue into this. Now, Roxanne raises a funny question here, and it is a valid comment, and that is, what if you default on your mortgage? Okay. So what's going to happen here is we go through the normal foreclosure or power of sale proceedings. So under most mortgage agreements, you can typically miss 3 payments, and then your RRSP has to foreclose on your mortgage, okay, which means it now owns your house, and then it must sell the house. Okay, that's good. And that would all be administered by BMO in this case, which of course they're going to charge you for, or they're going to charge your RRSP for, more accurately. Okay, that's fun, isn't it? So that is one way, for what it's worth, that an RRSP can directly own real estate. All right, that's all good. So honestly, I have seen exactly this thing done, Stephen. What I'm showing you here, I actually met a guy on a plane once who had done exactly what I'm showing here. And he was very much in this situation. He was very, very close to all these facts. And honestly, the reason I think he did it was because he felt like he was getting some sort of win by not paying interest to a bank. Okay. That's what I think, Paul. Yeah. Okay. All right. Yeah, I mean, he knew what he was doing, in the sense that he understood what his RRSP had done, but I don't think he thought through the bigger consequences. All right. It's true, Nicole. Yeah, he gave up that investment gain from the market. Okay, now, one scenario where I could see this actually making sense is, let's say you had somebody who had gone through a personal bankruptcy. You don't have to lose your RSP in bankruptcy, right? RSP is creditor protected. You with me there? And that person has to buy a home. They're not going to qualify for a mortgage because of their bankruptcy. Maybe there you could do this and it might make sense. Okay, I would want to explore other avenues first. I don't know, Paul, if you want to talk about the situation you had, but I don't think there are very many cases where this makes sense. Okay, so maybe while Paul types that up, I'm curious about this, Paul, as to what makes sense here. I am generally not a fan, Ryan, as you may tell. Okay. Sorry, Paul, if you're typing out an answer here, but I'm going to push on to the next slide and we can deal with that if there is an answer coming. All right, let's move on then to home buyers plan, where we have had some recent changes, and I believe my changes are not all reflected in the textbook yet. So first off, how much can I access using the home buyers plan? Perfect. I can access up to $35,000 per spouse or common law partner, okay, to buy a qualifying home. Okay, generally speaking, what this means is that you have not owned, not purchased, but owned, you have not owned a home in Canada in the previous 4 full tax years. And that's a January 1 to December 1 or December 31st period. Okay, that's what we mean by 4 full tax years. So as long as those things are true, then we can use the home buyers plan. Now there is another criteria. What's the new rule here that also gives you an opportunity to use the home buyers plan? What changed last year around this? Yeah, that's it. You can also use the home buyers plan post marital breakdown. Okay, and the other situation that I think is not but he has, so I don't understand, sorry, Paul. So he's not making a withdrawal from his RRSP? So right now his RRSP was used to create the mortgage. I guess I don't understand the, okay, but he is taking money out of the RRSP then, isn't he? I don't understand, sorry, Paul. It sounds like he is taking money out of his RRSP. Yeah, that is different, Paul, right? So that's not, so you're actually taking money out of the RRSP. That's a different question, right? That's really just about how you're using an RRSP withdrawal. But the RRSP in that case is not actually holding the mortgage, right? So the mortgage is at whatever institution. Yeah, that. Okay. Yeah, that does not feel the same to me, Paul, so we just talked about, but maybe I'm missing something there. Okay. All right, so. Okay, yeah. Yeah, we'll talk about that in a second, Bonnie. Yeah. So, and you can also use the home buyer's plan to buy a house for a child with a disability. Okay, they qualify for the disability tax credit, even if you currently own a qualifying home. Okay, does that all work? Now, in order to use the plan, and to your comment, Bonnie, yeah, your funds have to have been in there for 90 days. Okay, so funds have to have been in the plan for 90 days. So yeah, you could absolutely do that. You can make a big RSP contribution, and then next year, or even later in the same year, withdraw the funds under the home buyer's plan. You can get the deduction and use the home buyer's plan amount. And I do actually like that strategy in some cases. I think that can be a valid way to purchase a home, as long as somebody can plan their home purchase more than 90 days in advance, which I don't always see done. All right. So yeah, that makes sense, Andrew. That can make sense anyways. Again, very situational, right? Okay, so the funds must have been in the plan. And then you must purchase or build the qualifying home by October of the year following the first withdrawal. Okay, and your last withdrawal can't be more than 30 days after you occupy the home. So you can make multiple withdrawals here up to that $35,000 amount. Okay, so occasionally you do see somebody who tries to buy a home. You see this with condo development sometimes, right? Anybody on the call ever have a client who got caught up in a bad condo development? They made a down payment and then the builder backed out or had a zoning problem or something like that. Yeah, that happens, right? So if you have that happen, of course, in the Lower Mainland, Todd, right? If you don't buy the home or occupy the home, really, by the October in question, then you can do one of two things. You either repay the amount back into your RRSP, or you can apply to use a replacement home. So you can say, look, my condo thing fell through. That's not going to happen now, but we're still going to buy this place. We just won't be in it until January of next year. And as long as you explain to CRA the circumstances, they will generally allow the replacement home. They just need to see something. Okay. All right. Now, I do want to show a little bit of a, and this is something I find people overlook. I want to show a little bit of a rule here around the RRSP or the home buyer's plan that we don't really think about. The rule here is that you cannot use this if you've owned a home in Canada for the previous 4 full years. So here's the scenario that I want to work through. Let's say that I have a couple, and I know this is less, well, I'll try and make the scenario a little more realistic. So I have a couple from, let's say, Cape Breton, Paul, all right? And they they live in a house that they own. Okay, so they live in a house they own, and they've owned it for years. They bought it in, let's say, 2010. Okay, everybody's with me here? And then in, let's say, 2018, 2019, and 2019, they moved to, we're going to Ottawa. Ottawa's a good place to go for work today. They moved to Ottawa for work, okay? They keep the place in Cape Breton, but they rent it out. Okay. Now, is that place their home? That's true, they own it, but they don't live in it. It is no longer their home. Okay, it's a rental property. They went through a change of use, and now it's an income property, not a personal use property. Okay, does that all make sense? Okay, could be Airbnb, more likely long-term rental, but could be, sure. So now let's say that they rent it for all of 2020, 2021, 2022, and 2023. Okay. Maybe, I don't know, Ryan. I don't know. I don't necessarily like one rental property in a corporation. I'm generally a fan. Once you get to 3 or 4, I like the corporation, but whatever. All right. So in 2024, now they figure we're going to be in Ottawa for the long haul. It's time to buy a home in Ottawa. That's good. So now they could use the home buyer's plan. Okay, because they did not own a home in the previous 4 full taxation years, 2020 to 2023 inclusive. All right, does that all make sense? Yeah, sorry, I didn't clarify that. They rent for that period. Okay, thank you. It's a good clarification. All right. Okay, that all makes sense? So you don't actually declare a status of that property, Bev, but what you do is on your 2019 tax return, you file a change of use. So there's is it 2313? I can't remember the paper, but it's, I think, T2313. You're going to file your change of use, and that's what's going to trigger that. And then you're going to show rental income for those next 4.5 years or whatever. Okay, perfect, Stephen. That's pretty fancy. Yeah. Okay. We're all good there? Okay, now another possibility here is, and I don't care about the Cape Breton situation now, so now let's just say that I have a couple who lives in Calgary. Okay, they own a home. They have a child, age 25, with a disability. Okay. Yeah, it's not that I don't care about Cape Breton. We're just switching gears here, Paul. All right. And so this child, age 25, with a disability, they say, well, we want to help them out. So they can use their home buyer's plan, even if they own a home here. So they can use their home buyer's plan to access funds to help this child buy a home. That's good. All right. Now, my other comment here, the other qualifying factor is you cannot owe on the home buyer's plan and use the home buyer's plan. So even if you haven't owned a home in the previous 4 years, if you bought a place and sold it and rented for a while or whatever the case is, you have to clear any home buyer's plan balance to use the home buyer's plan a second time. Okay, that's all good. And of course, the last thing we have to look at here, which is a little bit complicated, is the repayment schedule. Okay, sort of, Stephen. Yeah, it's actually a little more complicated than that, but it is based on 1/15 per year minimum. Okay, but here's how it really works. So let's say that I have somebody who buys a house in 2020, and that's when they make their home buyer's plan withdrawal to go along with that. So there's no repayment required this year. That's good. And then what happens is in 2021, they get a year of grace. And again, no repayment required. Okay, still good. And then in 2022, that's the first year that if they don't make a repayment in the 2022 RRSP year, they have 1/15 of their home buyer's plan withdrawal added to income. Okay, does that make sense? And what's the RRSP year? What's the 2022 RRSP year? It really takes them, Carla, into 60 days into 2023. That's right. And possibly as many as 63 days, depending where the weekend falls. Okay. So it's not really that they have 15 years to repay. You see, from a certain point of view, you really have as many as 18 years to repay this thing. Okay. Now, it might not make sense to make your home buyer's plan repayments every single year. Has anybody ever had a client who deliberately did not make their home buyer's plan repayments? It's the same rules, Melanie. Yeah, same rules, except that you don't have to meet the didn't own a home in the previous 4 full taxation years rules. But other than that, it's the same rules. Funds have to be in there for 90 days. The child would have to be in the home by October the year following. Yeah. Okay. Yeah, that's exactly it, Bev. Okay. It's all based on the RRSP year. I don't want to say calendar year grant, but RRSP year. Okay. So the RRSP year is January 1st until 60 days into the next year, right? That's your RRSP year. Okay. So it may make sense if you have a year of low income. Okay, and that might be if you have a year off to have a baby, or you have a job loss, or a global pandemic, or whatever it is, then maybe you don't, I don't want to put an S on that, maybe you don't repay, okay? Maybe you take the income hit and don't repay. You do lose your RSP room, but honestly, it's probably not that big a deal if you have that event happen. Well, to me, Stephen, that seems like, sure, you could do that kind of planning, but I don't know if that's practical, right? I don't know if I would say it's wise. That seems like, I mean, there are other good reasons to buy in January, right? Often that Christmas season is a good time to buy a home. That's typically buyer's market, not seller's market, right? So maybe that's a reason to buy in January, but I don't know other than that. Okay. It does not, Sean, it does not. It just gets added right onto your income for that year, and you're still on that same 1/15 schedule. Yeah, exactly, Paul. I did mention that. Yeah, over in blue on the left side. You see it there? Child has to qualify for disability tax credit. Okay. You see near the top left there. All right. So I did try to cover that point. Okay. No, it's okay, Paul. All right. We'll take a break pretty quick anyways here. Yeah, we're a little over time, which I apologize for. All right. So then a couple of other things to show, and then we'll take our coffee break. If you die with a home buyer's plan balance outstanding, one of two things can happen. Okay. We can either add the amount to income that year, okay, or your surviving spouse essentially adds the 1/15 schedule to their income for the remaining years. Okay, so if you have a surviving spouse, that person can pick up that obligation, or we just add it to income for that year. It's essentially the same treatment if you turn 71 with the home buyer's plan balance outstanding. So if you had somebody who was 60 and they used this thing for the first time, so if you use the home buyer's plan balance and hit age 71, then you can't make any more RSP contributions into your own RSP. Yeah, exactly right, Mark. They would get a T4 RRSP if it's added to their income. Yeah. Okay, so if you use home buyer's plan and hit age 71 with the balance outstanding, you can do one of two things here. You can add the full amount to income at 71, or you can add the remaining 1/15 schedule for the remaining years to your income in those years. Okay. That's good. Yeah, exactly, Bonnie. So that person's going to have this choice at 71, either just to have a big hit to income or to have a smaller hit to income for those 5 more years. Perfect. I know there are people out there like that. All right. Any questions on home buyer's plan? Yeah, that's it, Mark. Yeah. Wait, will they get? I'm not actually sure, Mark. I don't want to say that definitively. They do get something from CRA. I don't know if it's T4 RSP. Or if you just get it on a notice from just checking here. Doesn't look like you get a slip. It looks like you just include it because you'll have your RSP or your home buyer's plan statement. There's no indication on the CRA website of getting a slip. So you just add it to your line 12,900 for each year. Same thing in that case, Todd. You would add it to 12,900. Okay. Doesn't look like you get a slip. Okay. You will get, so Stephen, you get a letter every year from CRA detailing your participation in the home buyer's plan, right? It says you have to put this much in this year or it'll be added to income. Okay. That makes sense. And that might have just been a notice, but okay. Yeah, so Todd, one thing you can do, I don't know if this is what you're thinking, one thing you can do, and this ties into Bonnie's question earlier, if you have one very high income earner in the household and they've never used their RSP room and they have a spouse who earns no income, that person could actually make potentially, if there's a lot of RRSP room, if they're going to buy a house, they could potentially put $35,000 into their own RRSP, $35,000 into the spouse's RRSP. You with me here? Combine $70,000. You get a big fat tax deduction on that. Leave the money in there for 90 days. And then if they're going to buy a house, they both use the home buyer's plan to the tune of $70,000. That's good. Okay. So yeah, you can pull that kind of thing off. And then if their spouse is not working, if the lower income spouse is not working and never works, it could work well that they just never repay that. So you essentially got that $35,000 tax deduction with no adverse consequences, except losing your RRSP room, right? But I think that's a worthwhile trade-off. That being said, I don't know that there would be very many circumstances where you would actually run into that. Maybe a person who's new to Canada who came here for a sort of high-paying executive type job. Okay. That's good? Yeah, that's what I'm shooting for here, Todd. All right. Okay, let's take a break there. So I have 14 minutes past. Let's take a 15-minute break. We'll resume then at 29 minutes past. Okay, we'll see you back then. Thanks.